How does the inflation rate impact Bitcoin? If the prices of everything are going up, shouldn't the price of Bitcoin go up too? Today we're going to be looking at how the inflationary rate impacts BTC. Now I'm sure lots of you have heard and seen in the news countless articles and had countless discussions about how everything's getting so much more expensive, and of course it is, but historically increasing inflation, increasing prices has historically led to increasing asset prices. As everything increases, surely the S&P 500, gold, Bitcoin should become more expensive? Or is the contrary true? If people are now having to pay more for their goods and services, do asset prices decrease? Well, we're going to try and figure a little bit of that out. So first of all, we're on the federal rate year-on-year change here on lookintobitcoin.com in the new macro suite section. And if we just go down here, I'll explain a little bit more about what the federal rate change is. But just to put it simply, if we're seeing incredibly high levels of inflation, prices increasing rapidly and substantially, the federal rate, which is chosen by central banks and governments, can be increased to deter lending, to deter borrowing, and increase repayments to therefore tighten the economy and try and contract some of the crazy inflation caused by rampant spending and credit. So once this increases, like we said, it's to try and slow down the rate of inflation. And then once we see this decrease, it's usually to let the economy breathe a little bit, to try and maybe incentivize a little bit more lucrative spending, try and get the economy growing again. So what we can see is a pretty obvious correlation here with BTC. Once this starts to decrease, especially historically, and especially if it's not increasing above zero, this has been a time for pretty bullish Bitcoin price action. And then recently, once we've seen this top out and start to decrease in the year-on-year change of the federal rate, it pretty much coincided with the price bottom of Bitcoin, similar to here in 2018, 2019. Once they started to decrease, it really signified that the next bull cycle had begun. But Bitcoin hasn't been around all that long. As we can see here, there's only a couple examples of the federal rate changing substantially and seeing the impact that actually has on BTC. If we go into TradingView here, what I've done, and I know this might look a little all over the place, but if we can see, these green boxes here indicate a period when the federal rate was decreasing. The federal funds rate has had a peak, and I've just mapped it out from the peak to the bottom of the federal rate change. And if it's green, it indicates that the S&P 500 increased in value. And if it's red, it indicates that the S&P 500 decreased in value. Now, as a lot of people are anticipating a federal funds rate top, a peak, and before maybe some decrease, which many people are seeing as a bullish event, we can see here there's some conflicting information regarding this. It seems that it historically used to provide better market conditions where potentially saw more speculative assets increase in value, but recently it's been the contrary, especially in 2001 and 2008. It indicated pretty much the peak to the bottom of the bear cycles. So I think what we need to do is look at other metrics, because I think just looking at inflation, just looking at interest rates, is just one piece of the puzzle. It's really just derived from the current sentiment throughout the market, the current liquidity in the market. If we look at the treasury yields here compared to BTC, we can see that almost immediately, again, we're seeing a pretty similar correlation, especially if we just remove all apart from, say, the 1 year. We can see once this started to decrease the treasury yield of the 1 year US bond, it marked almost the exact bottom of BTC price action. And again, as this dropped substantially during the COVID 2020 dump, as this bottomed out, it signaled the start of a major bull cycle in BTC. And the moment it started to increase notably, it marked the exact price action peak for BTC. But currently we're seeing some peculiar action in the yield rate. We're seeing here that it's kind of been volatile, moving to the upside and the downside. As it almost peaked here, it coincided with the Bitcoin bottom, and it started to decrease, or at least not increase substantially. But then we saw a little bit of an increase, and now it may be topping off once again. But again, it's leading many people to maybe be a little bit unsure on the future price action for Bitcoin and digital assets. If we just go to something like the high yield credit, this may give a little bit of a better insight into current investor sentiment. Because while it may intuitively be great to think of the answer of increasing prices as a black and white influence on the price of BTC, rather than just looking at something like that, we can look at something that's mapping out sentiment. And this is the risk appetite for high yield credit. So we just go here again, this will explain a little bit more here. But basically, this is looking at traditional market sentiment. When there's a huge risk on appetite and there's more and more capital inflows into high yield, potentially riskier corporate bonds, this usually coincides with the Bitcoin bull cycle as people are trying to pour liquidity and capital into more speculative markets to try and maximize their portfolio returns. Usually that's a pretty good time to be invested in Bitcoin and other digital assets. And again, once we see this decrease, it coincides with the Bitcoin price action decreasing pretty perfectly as well. And we can see here, this is pretty stagnant, fairly low at the minute, but historically, this has been a great level to potentially accumulate BTC before we see a bit of a change in sentiment to the upside, especially as we can see the US M2 money supply, which is the total circulating supply of all cash in the US, cash equivalents, savings, etc. We can see again, there's a very obvious relation between the two. As this bottomed out here in November 2018, it marked pretty much the exact bottom for the Bitcoin price action. And then as this began to increase, we saw the Bitcoin year-on-year change begin to increase rapidly until the US M2 money supply year-on-year pretty much topped out, marked the top in the Bitcoin price action too. And since then it's been contracting as Bitcoin's price action has been in a bear cycle. But we can see here, even though this has turned negative, meaning it's still contracting, we are beginning to see this slowly decrease in the year-on-year rate of change, pretty much aligning with Bitcoin finally seeing some positive year-on-year price action. And if we go to the global M2 money supply, not just looking at the US markets, but all global central banks, all the major global central banks, we can see a very obvious correlation between injection of liquidity into global markets and positive Bitcoin price action. As this bottoms out, it pretty much always marks the exact bottom in the Bitcoin price action, and also topping price action too. As this usually peaks, it usually coincides with a Bitcoin bull market potentially getting a little bit overheated. So while the inflation rates undoubtedly do have some influence on the Bitcoin price action, I think it's just one piece of the puzzle, as are pretty much all the metrics we've discussed. I think you need to get a broad general overview, not just of price increases or decreases, but trader and investor sentiment, available liquidity, and then you need to look at other fundamentals affecting assets themselves, such as the Bitcoin inflation rate decreasing due to the halving event, ETF news. Really, you need to take all of this in and come to your own conclusion by piecing all of these puzzle pieces together, rather than just relying on one miracle metric that'll tell you all the answers. Also, if you haven't already, please don't forget to like the video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all of the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your #1 source for Bitcoin information. So just to summarize, the inflation rate is a popular metric amongst traditional market participants and economists for gauging current financial conditions. And due to the leading influence of the US economy, there's been a strong correlation between the performance of more speculative and risk-on assets such as Bitcoin and cryptocurrencies with increasing and decreasing federal rate changes. The federal rate change being what central banks use to try and control potentially rising or decreasing inflationary rates. Although there is, however, some conflicting historical comparisons looking at just the one metric, indicating that inflationary rate may just be one piece of the puzzle for markets. Like we could see observing multiple of the macroeconomic charts, once we piece them all together, maybe it becomes a little bit clearer, but looking at just one in isolation can maybe blindside you with tunnel vision and own personal biases and opinions. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know in the comments down below and on social media, what are your thoughts on the current macro situation, and what metrics do you look to try and influence your investing decisions? As I said, I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.